Welcome to the program. Today we're going to talk about whether the market can break through 5,000. We'll discuss earnings season and who the winners and losers have been. Paul Rickard will give us his report card on what's going on in Canberra, and we'll talk about international investing, which is one of the themes for our upcoming Investor Strategy Day. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money. We've only got 2 minutes and we're going to cover each topic in no more than 2 minutes. First topic, Paul, market struggling to break through 5,000, but it has been a good, week, you would say. Bit down last night in the US, but overall a lot more green than red at the moment.
Yeah, up 4% last week, which sort of recovered from the week before. A good performance on Monday, I thought, but yesterday was a bit weak. We had a good lead from the US and we sort of ignored it.
Let it go.
Let it go, and I think we've got a US down tonight. So look, it was the old 5,000 mark. Look, you got to say there's a little bit of selling here. We've had a bit of a rally off the bottom. Yeah, oil price still in the news, and while the oil price sort of doesn't seem to have found a bottom, I think the Australian market's going to be a bit nervous. I think the biggest thing in our market in the last couple of weeks has been the iron ore price, which was yesterday hit $51, and we've seen BHP rally almost 20% from the low 14s to up in the $17 mark. It's a huge rally for that company. So we're getting a lot of positive from iron ore, but oil is still impacting, and people are still bearish on banks. I think there's some offshore selling.
What's your thoughts on what's happening with OPEC at the moment? There's a lot of chatter keeps coming on, and there was something in the press saying that yesterday that OPEC's going to start working with the US shale producers. What do we need to see to sort of get that oil price back to, sort of a level that I guess would be more acceptable to the Santoses and Woodsides of the world?
Well, that's the $64 question, Marty.
It is.
Look, I don't think you can trust anything OPEC says. I think there is a production glut. You actually need demand to pick up. I think that's the key issue. And you need to see more rigs close in the US. And until we get more evidence of that, I'm not sure OPEC can really influence this, but at some level, $30 US dollars is not economic for most non-OPEC producers, and so you're going to eventually see supply is going to trickle down and demand will pick up a little bit.
But as we've said though, a number of times on this show, that $30 oil price is very good for a lot of other industries out there at the moment, which we've seen in consumer discretionary and industrials.
People are missing that point. I mean, Brambles is one of the better results announced on Monday, even Boral last week. The impact of lower oil prices is all reducing their cost base. It may only be, people have been talking a lot about Qantas, but a lot of our industrial companies, and they're probably better examples than that, they're actually benefiting from lower oil prices, and that's one of the reasons that earnings season hasn't been too bad.
And funnily enough, Caltex reported well, and part of that result was based on the fact that people were spending more money buying the premium version of petrol, their Vortexes or the ultimate offerings that they provide, which is exactly the same fuel at a higher price.
Yeah,
go figure.
Go figure that. I mean, I have to buy that because my manufacturer said I've got to have the premium fuel.
That's right.
I'm sick of paying that 20%
Apparently, from all reports, there's very little difference between.
It's 98 octane or something.
It's like buying a Louis Vuitton handbag. It's all about feeling better, having that better fuel in your car.
That's your money-making tip. You really reckon I should ignore that?
I think you should. That could be the finance tip for the day.
Well, I think that we might save you a lot of money there.
Moving on, next topic. Now let's get into the heart of it. Earnings season, and all up, Paul, the results so far have been pretty encouraging.
Yeah, I think that the results have been actually really good. I mean, I think you'd have to give it 8 out of 10. I know Shane Oliver and others from AMP Capital do these statistics, but he keeps track of all the companies and the proportion that are reported above expectations, the number that increased their dividend, the number of higher profits. All those data is well up and normal. I think one of the most important pieces of data he compiles is how companies fare in the share market on a relative basis. So what happens to their stock price when they report? What does the market do with it? And on a relative basis, 64% of companies have seen their share price outperform the market on the day they reported. So that tells you the market thinks it's okay. But I could reel off, lots of really good companies that have reported.
BHP is obviously probably one that most people would like to get some insights into. Reported yesterday, no surprises, it's decided to cut back its dividend. What's it actually done there in that regard? They reported a pretty bad number though.
Yeah, look, I mean, I thought the cut was more than most people expected. I mean, we've been saying for some time they had to get rid of the progressive dividend policy. They did. They went from a dividend of 62 cents US per share to 16 cents. On that component, 4 cents was sort of what would have come under the new policy, and they sort of supplemented it with an additional 12 cents. Look, BHP, if you break the result down, iron ore was good. These are EBIT numbers, about $2 billion. Copper only made $100 million, and petroleum lost $200 million. So the problem is, with BHP is the oil and gas business that paid so much money to buy this in the US.
With write-downs, it was a significant
loss. With write-downs, it was a headline loss of about $5.7 billion.
Yeah.
But on an underlying earnings basis, iron ore's making all the money, petroleum's losing it, and copper's sort of just breaking even. So, look, I mean, BHP, it's all about iron ore. If you think the iron ore price is going to go up, I think there's some good investment there. I'm surprised by the rebound and the rally. I think maybe that's got a bit out of itself. But BHP is positioning itself for the next part of the cycle when it goes on the acquisition
Talking
trail.
about acquisitions?
Talking about it, I just hope it sort of is very patient, because I don't think we've seen all the damage and carnage
How would you
yet.
rate the management's performance so far? You'd have to say on the numbers wise, but they have had to deal with obviously commodity price collapses around the world. How would you rate them?
I'd give it 6 out of 10. I mean, if you just pick up any BHP half-year report, analyst presentation 12 months ago, 18 months ago, they have been consistently optimistic and bullish on commodity prices and consistently wrong. So management kept on trotting out all these forecasts. Chinese demand for steel is going to keep increasing. They've got it wrong. They've got it wrong big time on a forecasting basis. They say they didn't
Will
see...
any heads fly?
Well, I mean, the heads that should fly are probably the board, right? I mean, what really struck me yesterday about the BHP report was there was no mea culpa. There was no, hang on, we came out and told you we're going to keep the progressive dividend policy, and come hell or high water, we were going to keep doing it. There was nothing. Oh, it's just we've changed the policy. They should have announced this 6 months ago or 3 months ago.
Yeah.
So, look, I've got a little time for the CEO. I mean, I think Jack Nasser's got to go. He was partly responsible for the last acquisition of the oil shale business in the US. There's changes on the board needed. There's got to be some blood at board level. Maybe management's got it right. Maybe Jack McKenzie's got it right yesterday with some further management changes.
We're going to stay on earnings season because there's a couple more companies to talk about. So another big one that a lot of people would have exposure to reported yesterday was Wesfarmers.
Wesfarmers came in this morning, Marty. It's pretty well on expectation, $1.4 billion. That's the same as last year. The reason the same as last year is, of course, it's a conglomerate, and the resources part of the business slipped into a loss, which you'd expect. But really strong report from its supermarkets in Coles, and also Bunnings and the office supplies business.
Kmart.
Kmart did well. Target's a bit on the low side, but look, some good numbers there. Their sales figures, which they've reported on the same store basis, are also pretty positive.
Yep.
Up in terms of alcohol and food in the last quarter. So what will be really interesting is when Woolworths reports on Friday, is just seeing whether Woolworths has made any progress on the sales side compared to how it's going with Coles, its main competitor, and how it's going in terms of Big W versus stores like Kmart. So look, overall, a really strong report from Coles, Kmart and Bunnings and the office supplies. Not so good for Target, and of course, the challenges in the resources business you'd expect. So I think the market's going to like the Wesfarmers result. It's one of the few companies that's up this year. So it's doing well, and it's good management.
QBE was another company that came on the show during the week. They've reported well. Your thoughts on their result?
Yeah, look, I haven't been a fan of insurance, but QBE certainly seems like it's turned the corner.
They had some problems there for a
while. They've had some problems. I, like many shareholders, lost some money on QBE. I hate insurance companies, but look, that was a good report yesterday. The market, I think, took the share price up about 8 or 9% as a result. Again, another one of those companies, it seems like it's on the up. It seems like they've got far more sense about how they're managing their business, and they've got the right management team. I think a couple of others that have been really good. I really like the Brambles report. I like Boral. You can't go past Cochlear last week, but generally you can reel off most of the names.
Telstra? They report on Thursday.
Telstra was probably the one that was a little disappointing. I mean, it was very much as they forecast, but the market sort of said, well, 1.4% growth in EBIT was okay, but not exciting.
And there's talk again.
And the market sort of sold off Telstra as a result because...
And there's always there seems to be this ongoing talk with any new Telstra CEO about acquisitions.
Yep.
Appear to be on the table again, which, as you've said a number of times, historically, Telstra aren't good at making acquisitions. So do you see any risk for the stock based on that?
Look, I think Telstra's probably back into the buy zone, getting down towards $5. I mean, there's always that risk. I think Telstra keeps on saying it wants to be a world-class technology company. That's its ambition. You talk to users, you don't quite get that. You just look at the financials, you don't quite see that also. So, look, I've got a bit of time for Telstra, but I think it's probably more back in the buying zone around about $5.
Good stuff. Moving on, we thought we'd touch on politics today, and there's obviously a lot of rumblings going on, and it's keeping journalists very, very busy at the moment. Your thoughts on the Turnbull government and how they've been performing so far? There seems to have hit a bit of rough water.
Bit of rough water. I mean, I think the press is getting a bit impatient because there doesn't seem to be any action. I mean, they seem to get themselves in knots all the time. I can't believe how this whole capital gains tax fiasco in the last day or so has come up. And look, I don't know who's ratting on who down there in Canberra, but there just seem to be these incredible leaks that keep on coming out all the time, and how these talking points get leaked. How even look, let's just put it in context. The capital gains tax discount for personal investors is a big issue. So the Labor Party's plan to halve the discount, will take the effective tax rate. If you're paying tax at 49%, which is the highest rate, from 24.5% to 37.5% or 37.25%. That's a big rise. And so if that doesn't take it, that's on nominal gains.
All assets, property,
not real
shares,
gains, all assets. That's a big thing. And remember, and we could talk more about why the system was introduced. But the thing on superannuation, look, at the moment, a superannuation fund in pension phase pays 0% tax, so it pays no capital gains. In the accumulation phase, it pays a tax at 15%. A third discount gives it a tax rate at 10%. Changing that discount from a third to a half takes the effective tax rate from about 10% to 12%. It's 2/5 of FA, it's a nothing issue, but yet they've let it run and they can't control it. So how does that even get out there? I mean, I don't know. I mean, look, maybe the best thing is an election. Let's get them back into power. Maybe, Morrison's, he's been locked up as you can't roll him out anywhere now. I don't know. Maybe it's still an L-plate government.
What would you give Turnbull out of 10 report card so far? Promised a lot earlier.
Look,
how would you say he's performing?
I'd say probably a 6 out of 10. It still looks like they're on learner plates. I mean, and there's still this disunity. I think the most worrying sign is these leaks. And I don't know who it is.
We probably could guess. Last thing we're going to talk about today is our Investor Strategy Day. And we're going to actually talk about, I guess, one of the themes that we're going to be discussing on March 16 and March 17 in Melbourne. And that's the whole concept of international investing, Paul. We've got a couple of great managers there, and the guys from K2, an active fund manager, and also a passive manager in ANZ ETFs, and Charlie Aiken, of course, is a global fund manager. What do you think will be the key topics for discussion on the day? And also, what's your thought on investing offshore at the moment?
Well, I think there are really three things why you should invest offshore, and that obviously will come up. Secondly, hedged or unhedged, which I think is a big issue, and a lot of people don't understand that, and sometimes the managers do that, and sometimes they don't. So really understanding what sort of currency exposure you're taking and whether you should be taking. And then I think, so the first one obviously is why and the reasons for that, and thirdly is sort of how to do it. And it's probably the hardest thing because, we can all sort of look at the Australian share market and we can all buy shares or, it's not hard to do. But offshore, what do you do? Do you go through a manager?
Do you buy directly through an online broker?
Yep. Do you? What countries are you looking at? I mean, you're just looking at the US markets. Are you looking at US and Europe? So you take a global approach, or do you narrow it down into a more country-based approach? Do you look at particular sectors that you can't get in Australia?
Which in sectors like IT and media, we're very underweight here compared to some of the global behemoths in the US.
And then do you look at things like, do you do it through an active manager, where in many cases they're taking quite niche views, and so you may not be getting broad-based exposure, or do you look at some of the ETFs? And the ETFs could be everything that cover global indices to incredibly specific parts of markets. So I think there's a lot to put on the plate. I think the question that most investors have with overseas is, how do I do it? And at least by having a couple of experts from different parts of the market, that'll at least I think help people out there in the audience at least come to grips with some of the options about how they might do it. I know that from the questions that we get, Marty, look, you don't get the same question about how to invest in Australia. Offshore, you get that question time and time again, and you've got to work out what's right for you and where your fund or where your...
And what are the structures you can use to do it.
And what are the structures you can use to do it.
That's all we've got time for. I'm Marty Switzer.
I'm Paul Rickard.
And we're
Mad About Money.